Hello everyone, and welcome to this webinar for life science and technology companies, advice and analysis in an industry full of opportunity, presented by Cowper Kreston, Barclays Bank and Complete IT. My name's Alan Poole, I'm Head of Technology at Cowper Kreston. We're a leading firm of accountants and business advisors to ambitious businesses, and we're proud to work with many brilliant life science companies and tech companies across the Thames Valley and beyond, ranging from small startups through to quite large multinationals. Everyone joining us today will be well aware of the impact COVID is having across the economy and society, not to mention the Brexit word. But by and large, the UK tech sector has really risen to the challenges, adapted and continued to thrive in recent times. The UK's contribution to the direct medical and scientific response to the COVID pandemic has been phenomenal and rightly taken the headlines over the last 6 months or so. And we're delighted to work with clients who are directly involved with that crucial work. But we've been equally delighted to see many of our other life science and tech clients out of the public eye perhaps, but making huge progress, adapting to the challenges and thriving. Based on what we've seen so far, the vast majority of our clients will exit the pandemic in a much stronger position than they entered it. And that really is remarkable, very different to what we might have expected and testament to the brilliance of the businesses that we work with. So we're really pleased to have you with us today, and we're delighted to join forces with Barclays and with Complete IT to bring you this morning's webinar. We'll be hearing from 3 experts this morning covering a wide range of topics that are highly relevant to life science and technology businesses. First, we'll hear from Richard Redman, Barclays Bank, who'll speak about some of the big picture topics and key themes across the biotech sector. We'll then hear from my colleague, Margaret Savory, who will talk about some of the key tax topics that are most relevant to technology and life science businesses. And then finally, we'll hear from Matt Riley of Complete IT, who'll talk about cybersecurity, with a focus on the risks that are specific to technology and life science businesses. Presentations will last about 45 minutes, and then we'll have some time for some questions, and that will be chaired by Dan Arnold from Barclays. If you'd like to ask any questions, please type them into the Q&A function. Dan will pick them up and put them to our panelists at the end. Okay, so that's more than enough from me. I'll pass over to Rich Redman from Barclays. Richard.
Good morning, everyone. Delighted to be with you this morning. My name's Richard Redman. I work in the large corporate banking team at Barclays, where I spend my time looking after a portfolio of clients made up from businesses in the tech and biotech sector. Increasingly, more and more clients from the biotech sector over the last few years, and we'll come into some of the reasons behind that shortly. So the sort of focus of my attention is the biotech sector. For the next few minutes, we're just going to walk you through a few key points that are exercising our minds at the moment. So if we could jump onto the next slide, please. So what are we going to cover? I'm just going to provide a brief overview of 2020 and then have a slightly more detailed look at the capital raising activity in 2020. Going to touch very briefly on the Brexit of impact, and then going to sort of think ahead as to what the key themes will be through 2021 and beyond. So let's have a think about 2020. In preparation for this morning, I looked at a positioning slide from a similar event 12 months ago, and it's quite interesting to see how we thought the year was going to be for the sector. And basically it was that everything was going to go particularly well. It was set for a stellar year. That was off the back of 2 very strong years of performance through 2018, 2019, where record levels of investment flowed into the sector. So that was our thinking late 2019, early 2020, and then of course, a few months into 2020, COVID comes along, and full impact felt around February, March time. And as Alan alluded to, that didn't necessarily have the impact that we may initially have all thought of. And apart from probably a momentary pause for breath, the sector has kind of kept calm, has very much carried on, and then more so really has really stepped up to help out in terms of activities around the pandemic, but also away from COVID related therapies has been really busy as well. In terms of sector performance, I mean, directly related to COVID, it's estimated that there's around 650 therapies being worked on around the globe, alongside just under 200 vaccines that are in development. So it gives you some sense of the scale of activity that's ongoing. Part and parcel of that is the number of collaborations and partnering agreements that were formed to help accelerate that work. And I think it's the recent survey suggested that it was £164 billion of investment has effectively flowed into those partnership alliances. So it gives you some sense of scale of the level of activity that are going on. And then because of COVID, the sector has been placed, really in the spotlight of media attention, and it's brought the sector into the consciousness of Mr. and Mrs. Joe Bloggs, who hear stories about what the sector are up to as they're drinking their tea of an evening as they watch the evening news. I can't really think of any other time where, obviously for the unprecedented reasons that is the COVID pandemic, where that's been the case. The sector itself, there were some initial fears around the ability to access clinical trials through the pandemic, but to the largest possible extent, they've been largely unfounded, and trials have carried on, albeit maybe not as efficiently as before or as quickly, but access to those trials has remained in place, and people are sort of progressing through the clinical trials through 2020. In terms of economic performance and share performance, the sector has outperformed the FTSE 100 in the UK, and we've seen a raft of new investors attracted. Very strong investment and capital raising activity, and I'll come on to a little more detail on that in a second. And then on top of all of that, you get to the end of the year and Brexit happens. It almost kind of disappeared, slipped under the radar, but not quite. On a BIA call I was on a couple of weeks ago, 70% of the participants said that they were relieved with the outcome, which I think is probably a fair reflection about how most of us feel. And again, we're going to talk about Brexit in a little more detail in a couple of slides' time. So if we can move on to the next slide, please, Lizzie. So this is a graph illustrating capital raised in the UK by UK businesses from the UK public market, and you will see the absolute amazing performance in 2020, which exceeds the funds raised in 2018-2019 combined. But you will also see the dominance of secondary raises. I think there were just 2 IPOs in the year, but market commentary suggests that's more reflective of the market more widely and not a sector specific issue. In addition to the 1.1 billion that was raised from the public market, there was a further £750 million from venture capitals and a further 120 million from the US market. So I think that gets us to around 2.3 billion in total, which is nearly double the prior year. So you see, notwithstanding the possible impact of COVID and how you think that might have affected investors, almost the reverse of that has been true. In addition to the known quantum of capital flowing into the business, there's businesses have also been accessing the Future Fund, but data on that is much harder to come by because we don't know participants don't tend to publish the fact that they've accessed the fund, so it's a little harder to call, but that's a yet further source of capital that's available to the market. Moving on to the next slide, touch briefly on Brexit, where I hasten to add, I'm not an expert, but more of an interested observer. So first two questions to look at, what do we know and what happens now? And then I'll just kind of look at what I think possibly the four key areas for the sector. What do we know now? What do we know? The relevant part of the 1,500-page document that summarises the current position. Within there was one paragraph on medicinal product. So that gives you some kind of scale of the level of detail that exists at the moment. So everyone is very much in information gathering mode, and we have only just started the process. So it's very difficult to understand how that's going to impact on the sector. So what happens now, a working group is formed to specifically work through the detail, and the optimism around that process is that working group is formed of industry leaders and is largely a non-political process. So my hope, and I think the hope of others, would be that we'd perhaps see a slightly more pragmatic approach, as parties around the table will be very keen to ensure that whatever is put in place is going to work for the biotech sector, both in the UK and in the EU, because obviously our interests are aligned. In terms of key areas for the sector, I've just highlighted four, and you'll see that's talent, data, regulatory authority recognition, and access to grant funding. I'll take them in a slightly different order than they are on the slide, for the reason that the first and fourth one, I think, are largely settled, so we kind of know what's happening there. One is around talent, where access to talent now, if you're taking skilled workers out of the EU, you're on the points-based immigration system. Businesses can still sponsor individuals to come into the country, and the process is as existed prior to Brexit for non-EU individuals. So that's an established procedure there. The only exception being Ireland, which has resorted to the pre-EU arrangement, where I think there is effectively freedom of movement. The other issue that's largely resolved is access to grant funding, where much to everyone's delight, access to the Horizon Europe funding has been maintained, and that is on the basis that the UK government will be a paying third party into that agreement. And there was obviously some concerns that source of grant funding was going to disappear. Two areas that are less certain. One is around data, where there's a 6-month effectively standstill agreement, during which time new arrangements will be worked out. And this affects data protection, the flow of data in and out of the EU, and how intellectual property is treated. So all those areas are very pertinent to the sector, and we just have to hope, to say, back to this optimism around it being a non-political process, that we get a pragmatic and workable way forward. The second of the four points that also has got to be resolved is around regulatory authority recognition. Clearly, the need to have another regulatory approval would make the whole process of taking therapies and medicines to market less effective. It wouldn't be ideal, but I'm sure the sector would be able to respond and adapt and overcome. And we've already seen in the news with the treatment of the AstraZeneca vaccine by the different countries, France and Germany having slightly different view, notwithstanding the stance of the EU regulatory body. There's potential there for divergence of opinion, and that could potentially affect access to markets. Moving on to my final slide, is just to cover what I think we will be seeing sort of going forward through the year. At the risk of repeating myself, and our opinion from 12 months ago, looks like we're set for another stellar year. In terms of capital activity, the sale of Kymab to Sanofi for 1.1 billion plus further additional payments of 0.35 billion is the largest valuation of a privately owned UK biotech business ever. So we've started the year with a bang, and hopefully that means we're set fair for further record-breaking activity in the sector and sort of capital flowing into it this year. The sector is going to remain in the spotlight primarily because of COVID, but I think the benefit of that will wash through the sector more widely. Matt Hancock's statement offering the UK's genomic expertise to the world, I think puts the UK right in the centre of global activity, and I think there will be a benefit from a desire to have greater resilience to COVID and the variants that will follow undoubtedly, or the next viral pandemic. So I think there'll be much more preparation around whatever might happen next, and again that's going to flow investment and work into the sector. There's going to be the continued need for artificial intelligence and data analysis skills in the sector will continue. That's very much here to stay, and you see many businesses contemplate whether or not they should recruit expertise or outsource, and that's going to be pertinent going through 2021 and beyond. And finally, Brexit. It's a case of watch this space. I think we can proceed reasonably optimistic, based on it being largely a non-political process now. But also, my personal view is that COVID will drive a sense of greater cooperation between governing bodies, because they want to make the process as efficiently as possible, and I think there'll be some benefits to the sector as a whole because of that. And on that note, I will now hand over to Margaret.
Good morning, everyone. My name is Margaret Savory, and I'm a tax director at Cowper Kreston. I spend a lot of my time assisting fast-growing tech and biotech companies with their corporate tax affairs. And so I'm just going to romp, and it's literally a romp, through some relevant tax changes that I feel you should be aware of or might have of interest to you. And the next slide just shows you the areas I'm going to cover. Most of these I'm just going to flag up for awareness, so that you will need to look according to your own relevant circumstances. So first up on the list is looking at R&D tax relief. So thanks to the joys of interactive technology, I've got a little quiz for you. And I'm going to ask you, how many of you in your company currently claim R&D tax relief? And all you have to do is click on the button, and hopefully we'll have an instantaneous result from all of you. So we'll just let the technology do that. If you could just vote now. And then the first slide that I've got up, and what have we got? We've got over 2/3 of you claim R&D tax relief and 1/3 don't. So first of all, I'm just going to, I assume, as 2/3 of you know, that most of you are familiar with the UK corporation R&D tax relief scheme, but this slide just gives you a high-level overview. So you have to be chargeable to corporation tax, which basically means you're a company, and you're undertaking qualifying projects, which are those that seek to create an advance in science or technology through the resolution of scientific or technological uncertainty. That's your qualifying projects. What can you claim against? Qualifying expenditure, which includes staffing costs, consumables, and certain subcontracted activities. So it's a restrictive list in the legislation. There are two schemes you can qualify for. The SME scheme, which is for companies or groups below 500 employees and one of turnover below 100 million euros and gross balance sheet 86 million euros. So if you're below those limits, you can be in the SME scheme. Above that, you're in the large scheme, which is known as the R&D Expenditure Credit Scheme, or RDEC. Incidentally, if you have subsidized expenditure as an SME, you can only be in the RDEC. And by subsidized expenditure, I mean things like grants, other people paying you money for your R&D. If you look at the next slide, just to remind you the current benefits, the RDEC on the left-hand side, the large scheme, or you're receiving a grant or subsidy, you currently get back about 10.5% net. Then across on the SME scheme, much better. You get an additional 24% tax saving effectively, so 24,000 in 100,000. If you're profit making, or if you're loss making, you can cash in to get a refund of up to practically 1/3 of your qualifying expenditure. So that's a brief overview. Now on to some of the changes, and there's been a lot going on in the R&D tax relief world. Last year, they increased the RDEC to 13% gross, which gives us the 10.5% net. It was 12% previously, so that's some good news. However, the bad news is from April 2021, so in a month's time, there is going to be a reintroduction of a cap restricting cash refunds for loss-making SME schemes. And that's going to be restricted to 3 times the total PAYE and NIC bill of the company. And this was introduced as a result of HMRC getting worried about various large-scale frauds that were taking place. And the problem is hardest hit potentially are legitimate tech startups. So these can be companies, and typically these might be in the biotech sector, few employee costs, you're just employing one scientist, say, but you then subcontract a lot of your R&D work out to a third party, say the university. And so you have very low PAYE and NIC costs. HMRC listened and heard the complaints, and they have issued draft legislation, caveated it's still draft, it hasn't yet been enacted, with mitigations. So now I'm hoping that most of my clients will fall out of the cap. And if there's one take-home slide, if you're worried about the cap to take, it is the next slide, which I will bring up. So this is the mitigations that we have. So there is a total exemption from the cap if you satisfy 2 hallmarks, and that is you actively manage your IP, and it is absolutely crucial there that you retain supporting documents to support the active management of the IP. That might be correspondence with your patent attorneys, filing patents, and other such things that demonstrate that you manage board minutes, anything like that. And it's an and clause, so you've actively managed your IP, and no more than 15% of your overall R&D expenditure is what's called connected party expenditure of subcontracted activities, and including if you just get workers from that that's connected entity. And connected parties, we basically mean think group. So a fellow subsidiary, a parent, or a subsidiary. If you get workers or subcontract activities to them, it must be below 15% of your total R&D. If you satisfy that, you don't need to worry, you will get your cash refund uncapped. If you don't pass that test, you've got a de minimis limit, which your refund will remain uncapped if you get below 20,000 plus 3 times the PAYE and NIC bill, which can actually up the threshold to quite a lot. And unfortunately, if you're above that, the cap will apply and you will get the lower of that de minimis level or your refund. A few points on this slide. Note that it is the total PAYE and NIC of the entire company if you are employing workers, so not just those involved in the R&D. And secondly, that figure of PAYE and NIC also includes the proportion of PAYE NIC on the connected party people that you've brought in, either subcontracted. So you can claim an element of the PAYE and NIC in your multiplier of the 3 times. Really important, please be aware of the cap, it is coming in, and check you fall out of it, and you need to retain your documentary evidence. If we go back one slide to the list, right, so we've dealt with the cap. A few other things that have come up. The Hardy case, you can Google it. It was published in November 20. It's been rumbling through the tribunals. This came out from the first tier tribunal for the last 8 years. That just shows how long our HMRC take to get things through the courts. But in short, HMRC won, and basically the won because there was an absence of documentation to support the claim. And they applied the SME scheme incorrectly because they had subsidized R&D. And really watch that point, because if you have Innovate grants or someone else pays for your R&D, you cannot claim under the SME. You can probably only claim under the RDEC scheme, which isn't as good. And finally, the last point on that slide is that HMIC have consulted on widening of the definition of costs. Currently, the only computing activity that is included as a qualifying cost is software licenses. And so things like data center charges, internet provider charges, cloud computing charges are currently not eligible for R&D relief. And this is due to historical reasons, because the R&D legislation was written in the year 2000 before all these sorts of things existed. So they're trying to bring the legislation up to date. Watch this space to see what comes back from that consultation document. Okay, moving on. A brief slide on times of corona. I get a lot of questions asked about this, and basically you're probably okay under the SME scheme if you're thinking about getting one of the various grants or loans from the government. The SME scheme is notified state aid. The only other one that is the coronavirus business interruption loan scheme. In theory, you can't get state aid for both. However, HMRC's view is that CBILS is something that applies for the company as a whole, and SME R&D tax relief is for specific projects. So as long as you make sure that they're for the separate things, you should be okay. So one to check, though, is your wording on your CBILS application. Moving on, right, we've done R&D, we've done coronavirus. Moving on, quick update on UK Patent Box. No changes there. At its simplest, UK Patent Box is a reduced rate of corporation tax of 10% for profits derived from patents. As you can see there, it is a complex slide. There are no changes, but a special date is coming up. This was introduced on the 1st of July 2016, and up until the 1st of July 2021, you only had to do the left-hand side calculations. Now, with effect from 1st of July 2021, everybody has to do the right-hand calculation as well and combine the two. And highlighted in yellow there is the R&D fraction, which is the new step that has to be introduced. And if we have the next slide, that drills down on what the R&D fraction is. Again, I cannot go into it in detail. And for most, the key take home is that for most standalone companies, it will be 1/1. But even though it might be 1/1, HMRC say you still need to map your R&D expenditure to your patents or patented inventions. So there is a little bit of work that has to be done there, and they expect you to do that backdated from 1 July 2016. The key thing to look at the denominator there is the A. This is the one to watch. You might be fine. I'm going along doing 1/1 standalone company, but if you acquire a whole load of IP, which might affect or improve your patented products or activities, if that A is a lot bigger than all your other numbers, that is going to taint your fraction potentially. And the thing to note there on the next click of the slide is that this fraction is cumulative for 20 years. So if you have A in there because you've acquired a whole load of IP, that could taint your fraction and reduce your patent box profits for the next 20 years. Something to flag up and be aware of. That's it on patent box. Moving on. Right, the next thing I want to think about and just flag up to you is that we see a lot of tech and biotech startups moving overseas. So having to think about and deal with overseas issues, be it sales or employees or moving location. The first thing is to consider withholding tax. And I see a lot of people sort of do it and then after the event realize they might have had a withholding tax problem. This applies at 20%. So you as the payer has to deduct 20% on both the payment of interest and royalties to overseas recipients. However, depending on the double tax treaty or the EU directive, this can be reduced to nil. Post-Brexit, at the moment, the EU directive still applies. So for EU recipients, it is still nil. And for royalty payments, this is just a matter of putting a statement on your company tax return, though you do have to declare it, so your tax advisors should be aware of it. For payments of interest, however, it is necessary to apply for advance clearance with each HMRC before you make payments of interest. So just something to be aware of. For non-EU countries, you will, as ever, need to refer to the double tax treaty. And just for the next 3 bullet points, I just want to think of a typical case study, typical of a client I have. So it's a UK-based biotech company who have just recruited a new French COO who lives in France, and they're going to split their time between their French home, working for the company, then regularly traveling to the UK site of the company to continue their duties. So there are 3 tax implications there that you should need to consider by this sort of arrangement. Corporate tax residence, that's a separate concept from legal residence, and a company is tax resident in a country if it's either incorporated there or its central management and control is there. And a company can be dual residence, and then reference is made to various tiebreaker clauses in double tax treaties. Thus, if I move all my decision makers to another country and all the decisions and work taken overseas, potentially I might have changed my corporate tax residence. Even if the company itself doesn't migrate, potentially you could have a risk of creating a permanent establishment in the second country. The OECD definition is a fixed place of business or management. And if my CEO is over there, have I created a permanent establishment? No right answer, but you need to consider based on the facts. And finally, if my CEO were a scientific researcher undertaking research in France, is the company now creating valuable IP in France, or is it remaining in the UK? The OECD definition considers where you develop, enhance, maintain, protect, and exploit your IP, rather than just where the legal formalities are. So you need to think about where the location of your IP is being created and appropriately rewarded for. Each conclusion will depend on the individual facts, but as you can see, it's always important to seek advice or ask these questions before you commit to anything. Just following on from this, there are implications for the employee, the potential employee as well. So think about that CEO moving to or working some time in the UK. My colleagues in our award-winning multilingual expat global mobility tax team also get very busy as soon as clients start moving people around the world. So key is to establish that employee's statutory residence. Are they going to be in the UK enough to trigger UK tax residence? And even if not UK residents, there may be UK tax filing requirements. By definition, a CEO's duties in the world would be considered substantive rather than incidental to their normal work. So they are probably going to be taxable in the UK. So there's a whole raft of paperwork that then kick in, and I've summarized a few things to be aware of there. And even if you just have visitors, say from an overseas sub, where they visit once a month to catch up, you might still have reporting requirements under the short-term visitors agreement. So something to think about in terms of paperwork. And finally, just a brief reminder to flag up that there are changes to the off-payroll working, and this got delayed from last year. And there's a slide there for you to reflect on, but the key thing is that from April 2021, the onus will be placed on private sector firms to check whether contractors need to pay tax and national insurance contributions. And so this is a shift in responsibility from the contractor, that personal service company, to the person, i.e. the fee payer, the client, you, using their services. And if the next slide just says that this only applies to medium-sized and above enterprises. So broadly, medium size is 2 out of 3 of 50 employees or more, or 10 million turnover, gross assets 1.1 million. So if you're above that, you need to check the relationship you have with your contractors in terms of would they be an employee, were they not in a contractor relationship. It's important to seek advice because you could end up with PAYE, NIC liabilities that you didn't think you were aware of. That is literally a romp through everything. I just want to say, on the 3rd of March, we have the budget. Watch this space, and over to the next speaker.
Thank you, Margaret. My name's Matt Riley. I'm the Quality and Compliance Director at Complete IT, and I also have a role at our parent company, Sharp, as I'm the Data Protection Lead for the UK. I've been invited here today to talk to you about data in a sector where data is of the utmost importance, be that from protecting your intellectual property all the way through the special category data that you're probably going to have recorded, which could come with substantial fines if it's sort of accidentally leaked. There's lots that small businesses and medium-sized businesses can do to protect themselves. Complete IT itself is an IT consultancy, cybersecurity, hosted telephony and ERP support provider to about 700 SMEs across the 7 offices that we have in the country, relatively local to me. And here we've got High Wycombe and Oxford, for example. The first thing I wanted to do today is do a quick poll to get a bit of feedback. So the question is, has your business been a victim of a cyber attack or hacking? Most businesses think of hacking as someone's on my server, but actually Office 365 or Microsoft 365 accounts, them being compromised because someone's got your password is probably, well, it is now the biggest form of hacking. Horrible word, but hacking that exists. So if you'd like to answer the question, yes or no, it'd be really good just to understand this within what's going on with this group. Hopefully give it a couple of seconds. Perfect. Yeah, the vast majority say no. That is interesting. But again, that's a really positive story, unless these just events aren't being recorded, as an example. But that's really interesting. So if you could move on, please, Lizzie. The pieces I'm going to look at to do today are where we've come from in terms of cybersecurity, what you need to understand as an SME, how you can protect your business with some 5 or 6 simple steps, and sort of the latest trends and threats that we've seen coming through our client base. So hopefully I can bring something to the table with this. And this is the example of a really top level network diagram that I drew up about 6 years ago. And what this really is demonstrating is that 6 years ago, all of a business's data was retained really within the four walls of its offices. We had only just seen the introduction of cloud computing with Microsoft 365, Office 365 back then. And people were starting to have remote working practices that kept them out of the office. So today's a little different, but this is where we were 5 years ago. And moving on to where we are today, this is just an example of a number of cloud hosting providers that will have your data. And the real key piece of this, it is everywhere. We used to have it nicely nestled within our offices. Now it is everywhere. So actually making sure that we know what we've got, where we've got it, how we've got it, etc., is really important. So today I wanted just to touch on not just cybersecurity, but the whole concept of information security, which is this sort of culmination of cybersecurity, data protection, all in one as well. So if you'd like to, thank you, Liz. What we come back to is the CIA triad of information security. So these are the 3 main things that everybody needs to do when they're dealing with data to ensure, by 3 actions, you need to make sure you're protecting the confidentiality of data. Again, everybody knows with the Information Commissioner's Office, if confidential data gets leaked, there's potential massive fines along that. But you also have to ensure the integrity of the data. So again, you might be collecting test results in. How do you know that once you receive those results, that data's integrity is as top as possible? And finally, then you need to ensure that you can have that data readily available. So if the data subject asks for it, for example, in a subject access request, you have to be able to respond within given time frames, 30 days, typically for a subject access request. So ensuring confidentiality and integrity and availability is absolutely key to every piece of data that you hold. And you can do this through 3 ways. You manage your people, and you put people policies and processes in place. You can put general policies and processes in place. And again, we'll come to some of these later on. And finally, there's the traditional cybersecurity piece, which is the technology controls that you can put in place. And again, these are all very much mixed together. And Some are stronger than others, but information security is that all-encompassing piece around cybersecurity, data protection, and what the business does and what policies and procedures it puts in its place to protect those data. So moving on, thank you. So what we're going to go through now is really to understand the what, where, who, why, and when of your data. And what data do you have? Where do you store it? Who has access to it? Why do you have it? And when was it used? So I've got some simple, hopefully nice and simple steps to follow through, which all businesses can do. So first we'll go on to the what, and it's really understanding what data you hold, because most businesses don't really know. Yes, you'll have your very obvious data, which we call visual data, which might be for this sector as well, data around your intellectual property, anything to do with your brand that's important or valuable. But then you start moving into also things like your trial volunteers and their health. Again, where you're collecting medical data on individuals, you've really crept into that special category level of data. So knowing what that is and where you have it is really important. But there's also this other piece of understanding what data you have. We all have employees. We keep data on them. We all have a very valuable supply chain and these partnership agreements. So for example, if that became public knowledge when it shouldn't have, you potentially are putting your own business at risk commercially because someone else could come and do that in your stead. And more modern anyway, especially when we're collecting data through websites, etc., and social media, that's very valuable data if it gets stolen or lost, or if someone else, competitors pick it up. And this is really the obvious data. Most people will understand this, but then you have the concept of dark data. And I think the general consensus is between 60 and 70% of data businesses hold, they don't know about. And that's because it was in a file on a file server 10 years ago that nobody has access to anymore, or nobody can see anymore, or where team members, for example, should be using OneDrive to share data, but instead are using Dropbox and their personal Dropbox accounts. So again, it's not data managed and known by the business itself. And as we've touched on in the previous slide, it's where is your data? And it's everywhere. Traditionally, again, as I touched on, that file server, your laptop desktops, your portable medias, traditionally that's where it was kept. But now people have, and team members have, easy access to a whole raft of other things. And again, one of the biggest problems we see is that, as I alluded to a second ago, businesses might set up OneDrive, but actually what they're doing, their team are using Dropbox, or their team are using their own personal OneDrives to store their business data, which again is a big risk to all organizations, especially if it's that intellectual property or that special category data. And then the final two pieces around what data you hold. So there's two concepts within the GDPR, the 6 principles. You've got the principle of data minimization, only ever keep what's required. And again, don't keep it forever. A lot of businesses we work with, they're proud of the fact they can go back and find their salary records from 2001. That's actually a bit of a problem. So the next piece is how then can you help protect yourself and look after your data? So these, again, go back to these process, policy, people and technology frameworks. So the processes. Article 30 of the General Data Protection Regulation says all businesses should have a record of their data processing. That's purely focused on the personal information. But I'd highly recommend you expand that scope. So it doesn't just cover personal information. It covers all of your valuable information. Next, have an information asset register. So this is a formal register of what all these systems are where you should be holding and storing your data. These two sort of combined together mean if you have a system compromise, you know what data you have and where it's stored. So again, when you in the Information Commissioner's office or there is an investigation that happens, example, you can be pretty confident in saying, I know what was compromised. And again, that's also why you don't keep data for a long time. So having adhered to a data retention policy, I'm going to keep my HR data, which is sensitive data on our teams, for 6 years post-employment. After that, get rid of it. You don't legally need to keep it, so get rid of it. That way, again, if you're compromised, you're not putting at risk ex-team members. Finally, people, reviewing who can access what and what they should be doing and what they can have access to is really important. And there's a principle called the principle of least privilege to make sure that, again, you are only giving access to your team the data they need. And I can't emphasize the next one enough, the people training. We as individuals are the weakest link in any business now. Falling for phishing attacks, falling for I'm going to press the accept button on multi-factor authentication. These are things you can train your team on, but don't happen very often. And the more you do, the more likely you are to protect yourself. And I've got an example of both of them later on. And finally, then the technology solutions. And this is the traditional cybersecurity. Protecting your physical devices, especially now when not all of us are working in the offices. Ensuring your laptops, desktops, servers, anything that people are working on have got good antivirus, they've got good anti-malware, they've got isolation tools in case they have ransomware and put them on them. You've got patching plans for them, all your softwares are kept up to date, managing these vulnerabilities. And again, when this traditional model of all being in the office, that was easy to do. It's much harder now, but it's very possible to do. And then finally, that looking at those systems, those hosted applications, those storage platforms, it is all about access to them that you need to manage. So having things like single sign-on, everybody knows multi-factor authentication from your banks, having password managers in place, and again, having advanced email filtering tools to help you protect yourself from phishing. Again, all just multi-layered approach that you can put in place on your devices and your systems to make sure the risk of someone else getting in there or someone doing something naughty once they're in there can really help with. Thank you. So a bit of a couple of stats for you. We will look at where we believe Complete IT's data has been put at risk. And typically this comes through where our clients have breaches. And actually 90% of the breaches we suspect have happened to Complete IT data through our clients have come and would have been prevented by multi-factor authentication. But a lot of businesses are reluctant to do it because what they don't want to do is ask their team to install apps on their phones. Although most of us and lots of us personally will have those apps anyway. So there is a bit of a reluctance around that, but it would solve these problems. And finally, I think it was the last quarter, 35% of the breaches that were reported to the Information and Commissioner's Office in the UK were related to phishing attacks, which is fantastically high, bearing in mind it was only a 0 a couple of years ago. So that's why training and development of your team is really important. And one of the really latest trends has been our sort of willingness to click approve. So we've had a number of examples now where someone has compromised someone's password, logged into their Office 365 account, but also had the telephone number of the person whose account it is and have rung them pretending to be Microsoft or BT and just saying, you've got a little pop-up going about to appear on your phone. Just click yes for me. That happens more often than not, which is really disappointing in us as humans, because actually one of the things they're going to look to evolve it to is a PIN number based system, not just an approve or deny, because as people we're drummed into as children, don't give out PIN numbers. So hopefully that will help. But again, it's in educating your team, not just to click yes. And finally, I actually run a phishing simulation on our teams at Complete IT. Bear in mind, we're an IT company. I think I picked the perfect bait there to win a PS5 for Christmas. And I mimicked this up. And one of the things we're seeing with phishing at the moment is they're hacking into systems, but then sitting and watching and looking at the organization's chain of command. They're looking at the way the people talk. They're looking at the language of emails, and they're being very clever around it. So I did a very good phishing attack on our own business. And again, things like looking at that email address at hrinternal.com. That's not the Complete IT domain. In this instance, the text wasn't right. The font wasn't right. We have a corporate font. It wasn't that. If you click over and hover over that click here link, you would also have realized that wasn't a Complete IT. It won't work, Lizzie, on the picture, but you can hover over the link and see where it's taking you off to. So again, these little steps, but we're seeing much more of it. Phishing and really the audacity of the criminals is getting much higher. So again, training, and more so than anything else is what I definitely recommend at the moment. So thank you very much for your time. And hope you found that useful. I'm going to hand over to Dan now of Barclays for any questions.
Fantastic. Thanks very much, Matt. And good morning, everybody. My name is Dan Arnold, Relationship Director here at Barclays Mid Corporates. I support a particularly interesting portfolio, which is focused primarily on biotech businesses around Oxford and the wider Thames Valley. That typically involves a close relationship through serious funding rounds, structuring your FX strategy, or indeed hard-earned deposits for the best possible returns. We also introduce businesses to our investment bank in London or New York, often through to an IPO on AIM or on the NASDAQ. I have the pleasure of having the last word today and hosting this Q&A session for the 3 speakers on this morning's webinar. So if you would like to ask a question, just hover your mouse over the screen for those of you that have dialed in to watch the presentation, and you'll see the boxes come up at the bottom, one of them being Q&A. So if you'd like to ask a question, just click on the Q&A button at the bottom of the screen, type your question, and then click submit. And we do have a few coming through already. There's one here for Richard at Barclays, which will kick off with Richard, if that's okay. I'll just read this out. How does the amount of capital available to the sector affect what the bank sees in terms of client life cycle?
Great, thanks, Dan. Great question. So I've been in role for around 15 years, and if we go back, say 10 years, the life cycle of a UK biotech was typically 1 or 2 relatively small funding rounds to develop a therapy, get part way along the way, then either big pharma would come in and buy it, or someone would turn the lights out when they ran out of money. But now what we see is investors and capital flowing into those early stage businesses and allowing those what are then at the time relatively smaller businesses go much further into the development process, get into clinical trials and the like. So we start to see much larger businesses with much more complex needs, possibly working across UK, US sites, but still pre-revenue, but particularly well capitalized, well invested. So we're seeing sort of much more complex needs sort of day to day for those type of clients, but they are also sort of much larger and sort of much more mature businesses. And this capital liquidity is giving those businesses the opportunity to get into clinical trials, and then either think about partnering or even think about taking therapies through to market under their own steam, which say 10 years ago was just not something that we didn't really see very often at all.
Yeah, thanks, Rich. And I'll join you. I'm seeing the same thing myself, actually, which is a lot of businesses spin out from Oxford, for example, who are undertaking Series A fund rounds, and again, it's becoming the largest Series A fund round that we've ever seen. As a spin out from Oxford University. So businesses are getting larger amounts of funds into the business, at an earlier stage in their life cycle. So yeah, I'd echo your points. Another one here that's come in for Margaret, please. Which, beg your pardon, what are the current processing times for R&D tax relief claims?
Yes, this is a question I'm constantly asked by clients. So this time last year, the HMRC was struggling and they had a huge backlog and things were getting delayed. Since then, they've restructured and they have aligned also both the processing times for the large or RDEC scheme and the SME scheme, and they are now and have been turning things around within 28 days. They've really mobilized forces into getting the cash back on the R&D tax relief. So we've seen a lot of clients getting their money back within just about on the month. However, I caveat that we are now into busy season. This is post the bulk of the December year ends. This is the busiest quarter for HMRC getting the claims in. They always get a peak, and I'm seeing slight slippage on that already. There's still clearly lots of hands on deck trying to get the R&D tax money out to clients because they're aware that in a way tech and biotech is what's getting us out of this crisis, so they need to keep the cash flow going to these businesses. But I think it's just a sheer volume of amounts of applications they're getting at the moment. They are slightly slipping on that 28 days processing. It's still relatively fast and a lot faster, but I think it might be more realistic now to start to say 6 weeks from putting your claim in. And obviously you only get your R&D tax relief at the point you submit an R&D tax relief claim. And when do you do that when you've got statutory accounts for the year, a completed corporation tax return, and your R&D tax relief claim. Hope that helps.
Brilliant. Thank you, Margaret. We do have just 2 or 3 minutes left, so just time for one more. And to keep it fair, I'll have this one for Matt, which I'll put your way, Matt, if that's okay.
Thank you.
What accreditations can SMEs obtain to demonstrate that they take data protection seriously? Good question.
Yeah, that's a good question. So the SME sector is really governed by, I'd probably say 3. You've got Cyber Essentials, which is, again, it's a self-certified piece for the typically smaller businesses. You can then move into Cyber Essentials Plus, which again isn't just self-certified, there is external certification there too. And finally, realistically, in this sector, you've got ISO 27001, which is an information security, very broad piece around how businesses protect data, not just personal data, but all the data they have. Specifically, you've got 27701, which is a GDPR version of that as well. So if you've got 27001, you can also go and get 27701. So for those businesses where you are working with lots of special category data, that would be a really good additional string in your bow as well, I suppose. But yeah, thank you very much. Hope that answered the question.
We do have a few more that are coming through there, but unfortunately, I don't think we're going to have time this morning, but we will endeavour to come back to you and follow up with those who have asked questions at the earliest opportunity. So we're just coming up on time there, and I'd like to leave you with this slide. Thanks, Lizzie. That contains the details of all those that have spoken this morning. Please do get in touch if there's any further burning questions that you have, or of course, if you'd like help or advice, we're happy for you to get in touch. I'd like to say a big thank you to Alan Poole at JCK and our 3 speakers, Richard Redman from Barclays, Margaret Savory from James Cooper Kreston, and of course, Matt Riley from Complete IT. Thank you very much all for speaking this morning. This concludes the end of the webinar. Thank you very much, everybody, for joining us. Stay safe, look after yourselves, and hopefully we'll speak again soon at some point. Thank you very much.